Ladies and gentlemen, feast your eyes on the fight you will never forget. For tonight's match, in the right corner, weighing 300 pounds and 2 times heavyweight champion, we have the Terminator. In the left corner, weighing 70 pounds and still scoring in the 7th break, we have the Unicorn Kid. Wait, what? How is this even a fair fight? This is child abuse.
Do you feel that investing is the same? Here you are in the corner with your small portfolio, and there you are up against the big hedge funds who dominate the market. Most of the trading that happens on the market is done by institutional investors. By some estimates, institutional investors account for about 70% of stock trading volume. When we invest, many of us believe that we can outsmart the big institutional investors and hedge funds. Bridgewater, BlackRock, Lone Pine, just to name a few. You may be thinking, because these guys are huge, they have massive amount of capital that can control the market. They have influence to access to the company's management. They have an army of analysts who can research the market much better than the retail investor. Some of them might even have access to insider information that allows them to front run the market. That seems to be common sense, right? In recent times, we've seen Wall Street Bets Reddit community trying to outsmart the institutional investor. They want to prove that it is possible to fight against the big boys. Just look at GameStop shares. The company is in a really bad shape. Its business model of selling games in physical shop is outdated. We see this reflected in the company's financial statements. Sales has indeed been declining over many years, and going by this trend, the company is on track to decline even more. Going down to its bottom line, we see that it's not even making profit. It's racking up year after years of losses. It's burning cash. Given this situation, its share price should not go up, but the Reddit community didn't care. They just wanted to prove a point. They banded together to drive the share price up from $10 to over $160. The big funds who shorted GameStop made massive losses. This proves that when little guys like you and I band together, we can be as influential as the big boys, regardless of the share price fundamentals. Of course, I'm not encouraging this kind of investing strategy. It is very risky and requires community support. It's always safer to invest in companies where the fundamentals support the share price. It's not wise to dump your life savings into a money-losing company in the hopes that others will play along. This strategy is also not sustainable in the long run. Instead, I'd like you to focus on the advantages of small retail investors like us over the big funds. No, we are not here to oppose them or prove any point. We are just here to make a profit. The thing is that we have more advantage over these big funds already, just that we do not know it. You see, let me ask you a question. How does the share price move? It moves due to supply and demand, right? The higher the demand, people start bidding the price up, and the higher the share price goes. Little guys like us have significant advantage when it comes to buying and selling shares on the open market. This is because our demand is really small. It's just a tiny fraction of demand. Because of this, when we buy and sell shares, we don't increase the demand, and as such, we don't really move the market at all. You might be thinking, hey, wait a minute, shouldn't the ability to move the market be a strength? When I buy, I want share prices to go up so that I can instantly profit. Not exactly true. When you buy, you want to buy the share price as cheaply as possible, right? You want as much discount as you can get. Institutional investors, because they are big, usually have a lot of shares they need to buy. In the process of buying a small but significant portion, they move the market prices up, whether they like it or not. For example, they of course have done their research and discovered that a company share price is worth $10. It is trading on the market at $9 now. They have a lump sum of $100 million that they need to invest. If the company is a small cap company, after they spend just $5 million worth to buy the shares, due to their buying action, it increases market demand. And as such, the prices may shoot up to $1.10, and they got no choice but to stop buying because they do not want to buy the share price above the $1 value. They are left with another $95 million sitting around, and this $95 million is unable to participate in the investment. Compare this to a small retail investor who may only have $5,000 to invest. They can easily invest all their $5,000 without any problem. That is just the first part of the problem. You see, after they buy, they eventually need to cash out and sell. What happens when they sell? When they are hedge fund, they have huge holdings, and when they have so many shares to sell, they move the market down whether they like it or not. The share prices go down and they get lousier prices to sell into. This gets much worse when selling in the midst of a crisis, when everyone is in a panic. The low prices will trigger more prices to sell out, triggering a death spiral. When you are in a shopping mall alone and suddenly a fire breaks out, it's fast and easy for you to escape alone, right? Fund managers are in the shopping mall with many of their clients. It's going to take a longer time for them to get to safety. Their speed is only as fast as the slowest person in the group. Running a big fund is like steering a big ship. When there is an iceberg in front and they need to turn around to avoid collision, due to the size of the ship, it takes very long for the ship to steer around. Compare this to a small speedboat. When there is an iceberg in front, it's fast and easy to turn the boat around. Secondly, under the SEC Schedule 13D regulation, when a person or group acquires 5% or more of a company share, they must report it to the Securities and Exchange Commission or SEC. If the beneficial owner holding changed by 1% or more, they must amend their Schedule 13D, and this information will have to be released to the public. When big funds buy a few $1 million worth of shares, they advertise their intention to everyone else. If everyone knows that they have intention to buy 10% of the company, they have to report this. This reporting is not optional. It is mandated by law and regulation. One thing's for sure, market will start reacting and start bidding up the share price in anticipation of their position. That's why institutions often do not sell their shares at one single sitting. They break it out into blocks to disguise their intention. It often takes weeks and months to get into a position or to get out of one. Compare this to a small retail investor. Who cares what do we do as individual? We can sell and buy all we want, and it won't make any significant impact on the market. That being said, I hope this video has given you much better understanding of the challenges that big institutional investors face. Contrary to common opinion, if you put in the work and stay smart, it's possible to outperform the S&P 500 average return. Average ordinary investors can expect 15 to 20% yearly return. It's more difficult for big fund managers to outperform due to their large funds. It's difficult for them to react fast to market changes. I hope this video has been helpful. Agree or disagree with my video? Subscribe, leave a like and comment down in the description, and I'll see you in the next video.